Hello friends, welcome to my channel Financial Fitness with CA Ashima Abel Yunus. In this video, I'm going to talk about the tax implications and tax planning with respect to the sale of real estate property by residents as well as non-residents in India. I will also give you some tips on the tax exemptions that are available in order to save tax on capital gains and also how NRIs can get a nil or a lower rate for TDS on sale of property in India. Through this process, NRIs or OCI card holders or even foreign citizens can get TDS relief before the sale transaction and therefore they can avoid blocking their money with the tax department for a period of about 1.5 years or maybe even more. So make sure you watch this video to the end to understand the tax benefits that you can avail, and in the meantime, make sure you do subscribe to my channel and like and share the video with your family and friends. Recently, I got some queries from my NRI friends on this subject, and that's the reason I picked up this topic for my next video. But this video, I can assure you, it will not only benefit the NRIs, it will also benefit the resident individuals who are planning to sell their real estate property or now or maybe in future. For my new viewers, I'll quickly introduce myself. Here I am, CA Ashima, a professionally qualified chartered accountant and a certified auditor. I have worked as a partner and a director with one of the top 25 leading CA firms in India, which has also been a member firm of one of the big fours. After working in India for a period of 10 years, I moved to Sweden and have worked as a senior financials consultant with a multinational and have also worked as a freelance financial consultant. So let's begin. If an NRI or an OCI, which is overseas citizen of India, or even a foreign citizen sells a property in India, they are liable to pay taxes on the profits earned from the sale of property in India, just as any resident individual would have to. But there are certain tax benefits that an NRI, OCI, or a foreign citizen can claim. Let's understand the two types of capital gain taxes. Short-term capital gain tax is levied if the property is sold within 2 years of its purchase at a rate of 30% plus applicable surcharge and cess. Long-term capital gain tax is levied if the property is sold after 2 years of purchase at a rate of 20% again plus applicable surcharge and cess. After adjusting for inflation index, surcharge rates are based on the amount of capital gain. So if the gain exceeds 50 lakhs and is up to 1 crore, then the rate of surcharge will be 10%. If it exceeds 1 crore and is up to 2 crore, then surcharge rate is 15%. If it exceeds 2 crores and is up to 5 crore, then surcharge rate is 25%. And if it exceeds 5 crore, then it is 37% of surcharge. This surcharge is calculated on the tax and then on the total amount of tax, including surcharge. Education cess of 4% is levied. Let's quickly see how capital gains are calculated. The capital gains are calculated as the difference between the sale price and the cost of acquisition of the property, which is indexed cost in case of long-term capital gains. Now let me explain what is indexation and how it is calculated. The indexed cost of acquisition is used to calculate long-term capital gains tax in India. The indexed cost of acquisition takes into account the inflation rate between the year of purchase and the year of sale of the property. So let's take an example. Let's say you purchased a property in India in financial year 10-11 for 50 lakhs and you have sold it in financial year 21-22 for rupees 1 crore. The cost inflation index, which is known as CII, for financial year 10-11 was 167 and for financial year 21-22 is 317. So now index cost of acquisition will be calculated by multiplying the cost that you purchased with the current year CII, which is the CII for the year in which you have sold the property, and you divide it by the CII of the year in which you purchased the property, which is 167. So that comes to approximately around 95 lakh rupees. And the long-term capital gains will be calculated by reducing the index cost of acquisition by sale price. Here in this example, it will be 1 crore minus 95 lakhs, which will be equal to 5 lakhs approximately. Tax is calculated on this gain, and this is where the tax planning comes into place. The question is how to save tax on capital gains. Residents as well as NRIs are allowed to claim exemption under Section 54, 54F and Section 54 EC on long-term capital gains from sale of property in India. The point here to note is that you do not have to invest the entire sale receipt, but it is the amount of capital gains that need to be invested in order to claim the exemption from capital gains tax. Let's understand exemption under Section 54. When you sell a house property, then under Section 54, you can claim exemption from capital gains tax by investing the amount of capital gains. Note that it's the amount of gain that you need to invest and not the entire sale proceeds for purchase of another house property, either 1 year before sale or 2 years after the sale of your property. You're also allowed to invest the gains in the construction of a house property, but construction must be completed within 3 years from the date of sale. It is mandatory that the new house property must be situated in India. The exemption under Section 54 shall not be available for properties bought or constructed outside India to claim this exemption. Do remember that this exemption can be taken back if you sell this new property within 3 years of its purchase, so you need to plan accordingly. But if you have not been able to invest your capital gains until the date of filing of return, which usually is around 31st of July following the financial year in which you have sold your property, you are allowed to deposit your gains in a nationalized bank or other banks as per the capital gains account scheme, and in your income tax return, you can claim this as an exemption from your capital gains and you don't need to pay tax on it. Now, when you decide to purchase the property at a later date, then you can withdraw your funds for the purpose of payment for purchase or construction of the house, as the case may be, but make sure that the entire chunk of money of your capital gains is moved towards purchase or construction of another house property only. You cannot use it for any other purpose. But if you are able to save on paying capital gains tax, then it is totally worth it. Let's understand exemption under Section 54F. It is available when there is a long-term capital gain on the sale of any capital asset other than a residential house property. To claim this exemption, one has to purchase a house property within 1 year before the date of transfer or 2 years after the date of transfer, or construct one house property within 3 years after the date of transfer of the capital asset. This new house property must be situated in India again and should not be sold within 3 years of its purchase or construction. And here, the entire sale receipt is required to be invested. If the entire sale receipt is invested, then the capital gains are fully exempt. Otherwise, the exemption will be allowed proportionately. Also, one should not own more than one house property besides the new house, or nor should the NRI purchase within a period of 2 years or construct within a period of 3 years any other residential house in order to claim exemption under Section 54F. Exemption is also available under Section 54EC. 54EC bonds are popular investment instruments, as investing in 54EC bonds also allows investors to claim tax deductions on long-term capital gains tax. The maximum limit for investing in 54EC bonds is 50 lakhs. The eligible bonds under Section 54EC are the bonds issued by REC, which is Rural Electrification Corporation Limited, PFC, which is Power Finance Corporation Limited, and IRFC, which is Indian Railways Finance Corporation Limited. Let's understand the key features of Section 54EC bonds. 54EC bonds are safe and secure and are AAA rated. Interest on these bonds is taxable. No tax is deducted on interest from 54EC bonds, and wealth tax is exempted. These bonds offer around 5.50% of interest rate. And the tenure is for 54EC bonds, it comes with a lock-in period of 5 years and they are non-transferable. But the biggest advantage here is that after a period of 5 years, you can withdraw your money and you can utilize it for any purpose. There is no restriction at all. After 5 years, it is not mandatory that you have to use it for buying a house property or any specific thing. You can use it for any other purpose as well. But note that you cannot claim this investment under any other deduction. You are allowed a period of 6 months to invest in these bonds. So to be able to claim this exemption, you will have to invest this amount before the return filing date. Now let's look at the guidelines and provisions relating to TDS, which is tax deducted at source, that are applicable on the sale of house property by NRIs in India. As per the Indian income tax laws, when an NRI or OCI or even a foreign citizen sells a property in India, the buyer is required to deduct TDS at the rate of 20% on the sale proceeds of a long-term capital asset And if it's a short-term capital asset, then the TDS is deducted at the rate of 30% by buyer plus applicable surcharge and cess. However, NRI, OCI, or a foreign citizen can obtain a lower or nil tax deduction certificate, which is known as LTDC, and the TDS rate may be lower or nil. To obtain LTDC, the seller is required to file the application in Form 13 with the Income Tax Department. It usually takes about 45 to 60 days to obtain a LTDC from the tax department, so it's better to plan it in a timely manner. NRIs can voluntarily apply for a lower TDS certificate to the concerned income tax department, which is the International Tax Department that handles the ITRs of NRIs. There are some supporting documents and information that are required to be submitted online along with Form 13, which usually include income tax login details, which would be required for the NRI or a foreign citizen, registration details on the lower TDS application portal, which is TRACES, the agreement entered into with the buyer for the sale of the property, TAN number of the buyer. In case the buyer is not in receipt of a TAN number, he can apply for it and get it in 2 to 3 days by filing a form, which is Form 49B, with the Income Tax Department. Then the copy of passport of NRI or foreign citizen, circle value of property involved, certified by a regulating authority, properly stamped and executed purchase deed of the property, and a proof of ownership by the owner, bank account details and ITR and other forms of the NRI. If the NRI is a resident of a country with which India has signed a DTAA, which is Double Taxation Avoidance Agreement, they may be eligible for tax benefits under the treaty. The DTAA provides for a tax credit in the home country of the NRI for the taxes paid in India. It is important for an NRI to comply with all the tax provisions and file their tax returns in India to avoid any penalties or legal consequences. So friends, it's time to wrap up this video, and I hope you all will benefit with the information shared in this video. So if you like the contents of this video, then please do subscribe, like, and share it with your family and friends. Thank you and bye-bye.